Good morning, everyone. My name is Chris Samlin, and I'm GeoPhy's Senior Director of Marketing. Welcome to our second quarter Tenant Financial Health webcast with Niels Koch, GeoPhy's Chief Economist and the Professor of Real Estate Finance at Maastricht University in the Netherlands. In a moment, Niels will be providing our Q2 update detailing Tenant's financial health in the U.S. multifamily properties based on GeoPhy's proprietary data, which has more granularity than other vendors provide to the commercial real estate market. But first, a housekeeping note. We've muted all microphones except the speakers, and if you would like to ask a question, please post it to Q&A and I'll raise it with Niels. Finally, we will be providing two additional ways to dive into this information. First, an archive of this webcast, including the slides, and second, a report based off the data we're presenting here. Please look for an email notification sometime tomorrow with the archive and the slides, followed by the report next week. And please pass them along to any colleagues who might find them beneficial. Now, take it away, Niels.
Well, thank you, Chris, and welcome. Good morning, good afternoon, everybody. I'm looking at my picture here, and as you can see from the current state of affairs, I'm also enjoying something that resembles a summer break, and I'm hoping you're doing that too. So the state of the multifamily market, the economy, and with it, the multifamily apartment market doesn't really seem to be in holiday mode. That's a good thing. It rather continues its positive momentum. The Wall Street Journal earlier reported this week that stock prices of publicly traded apartment communities, think about equity residential, mid-America apartments, are up 42% for the year. So certainly a pretty good year thus far. Average rents across the US are up 10% for the year and are now about 10% above where they were pre-pandemic, and that's of course on average. Against that backdrop or looming threat, we have the much discussed ending of the eviction moratorium. And as I prepared for this webcast, it ended, it started, it ended. Well, we have an extension of the moratorium again this week, but I would say all of these positive data points that we currently have are welcome news, no matter the outcome. So what are we going to do today? The generally positive momentum of the U.S. economy is certainly reflected in what I'll be talking about. We're showing tenants moving back into multifamily assets, albeit slowly. Transaction prices of multifamily assets that continue to climb in most places, and an overall significant improvement in the financial health of the 43 million renters in the U.S. Little advance warning, as Chris said, I'm the chief economist, so I'm certainly going to show you lots of numbers today. There's not going to be any math or statistics to actions in the Q&A, and of course, all slides as well as the recording will be made available to you. And if you have questions afterwards, feel free to reach out to Chris or to me. So before we start, some more details on the data that we're using in most of this webinar. We're primarily using GeoPhy's data on consumer credit, which covers virtually every multifamily resident in the US, with a time series ending as recent as July 1st. So the analysis are both granular from a geographic perspective and timely. Consumer credit data comes directly from financial institutions such as banks to the credit bureaus, and is used for the calculation of credit scores, delinquency rates, etc. And we aggregated information at the level of the individual multifamily asset with a minimum of 10 tenants. So we can never identify an individual tenant, and neither would any of our users be able to do that. In today's webinar, we focus on three key metrics when it comes to tenant financial health: the average credit score in a multifamily property, the average delinquency rate of tenants in a multifamily property, and the third metric is the so-called payment holiday. That's a special type of deferment granted by credit card companies and mortgage servicers, which became especially relevant during kind of the early months of the pandemic. Under the CARES Act, the first CARES Act, first stimulus package enacted in March 2020, payment holiday was granted to any consumer that applied for it. And we consider payment holiday, if people take a payment holiday, a hidden risk. It's a non-payment risk that's captured neither by credit scores and also doesn't show up in delinquency rates. In addition to these three credit metrics, we also capture data on household counts in each multifamily property. People register their address with banks, with credit card companies. You want to receive your cards at the right address, and they change their address obviously when they move in or out. As such, household counts for each property provide us and you with an accurate measure of occupancy and aggregated at the neighborhood, metro, or state level. That data provides timely insight into migration patterns, particularly or especially as it relates to multifamily property. Second note on data that we're using, coverage, a question that often comes back. A quick note on our multifamily universe. We use as our base analysis a large sample of multifamily properties that I would say covers pretty much all of the US. As a reference, and the census is not always right, but the census ACS counts about 500,000 multifamily assets with more than 5 units. So that's important. We look at more than 5 units. With GeoPhy covering about 92% of that by units, so 23 million units out of the 25, and we cover 62% of the census multifamily count by assets, so 326,000 assets. In some of our analysis, we concentrate on the top 50 metropolitan areas, given that's where most of the action is when it comes to multifamily. All right. So let's dive into the first part, multifamily tenant migration. Have we really turned the corner? As I just mentioned, consumer credit data can be used to shed light on whether folks are packing up or coming back to apartment buildings. And it's important to note that this data covers just tenants in multifamily assets. So while we can monitor outflows for areas very accurately, inflows could be underestimated if tenants buy a home instead of renting an apartment, or in case they're moving into a vacation home or increasingly popular single family rent. So we really have a multifamily focus here. Using the data on individual tenants and individual assets, we aggregate at a couple of different levels. And we think this data offers great insight into where to play, which markets are losing steam, which markets are picking up, and where there's that real rebound again. So let's start at the state level. Where have the tenants gone? So we go back to March 2020. It seems like a long time ago, but basically when the pandemic got into full swing. So the overall multifamily tenant migration map of the US with a focus on multifamily. Note that the numbers here reflect net migration at the state level, so total out minus total in. Migration within the state doesn't have an effect on the overall state numbers. Note also that real migration really only started as of the summer last year when people realized that the pandemic was going to last longer than just a couple of months, and when people really started to move out. So what we see here is that not surprisingly, the mountain states, Idaho, Montana, lots been said about that, have done really quite well, and so has Florida. From an absolute perspective, though, the multifamily inflow from a tenant perspective into the mountain states is really quite small. People move into single family rentals, they move into vacation homes. There's very limited stock really and new supply of multifamily assets there. So from a count perspective, you look at thousands of tenants, not more than that. Florida, on the other hand, gained about 16,000 new multifamily tenants really over the last 15 months. And the big chunk of that really came as of summer last year. DC, hard to see, but it's the biggest loser. That's not always the case, but certainly in the case of multifamily tenants. And that tenant population has been shrinking by about 7%. A couple of other states that are noteworthy, Illinois, Minnesota, California, all losing between 3 and 4% of their multifamily tenant base. In absolute terms, and that's important, that's minus 142,000 tenants for California and minus 28,000 in Illinois, mostly Chicago, and minus 14,000 in Minnesota. So pretty serious numbers. Then let's take a look at the metro level. So here in this chart, you see the multifamily tenant change from March last year again at the metropolitan or big city level. So metropolitan area is really kind of a New York plus or a San Francisco plus, slightly more than just a city that you typically think about. So since March 2020, basically all metros have been losing tenants, with the exception just of a couple of cities in the Sunshine State that picked up tenants, as well as surprisingly, perhaps Buffalo, New York. I continue to think, who want to live in Buffalo, New York, but who knows with climate change, it might be the new Côte d'Azur of the north. The numbers confirm here that the Bay Area has decreased significantly in popularity, with the tenant base in San Francisco declining by 6% or 40,000 tenants. So out of the 142,000 tenants in California that so-called disappeared, at least out of multifamily, 40,000 of those are in San Francisco alone. Silicon Valley is another 5%. Of course, that's a smaller base. The same holds for the West Coast darlings such as Seattle and Portland. So let's look at rebound a little bit. Over the past months, things have started to improve. There have been plenty of stories about the rebound of cities and the rebound of multifamily in cities. So let's look at the facts here. This graph shows the net migration trend since the start of the pandemic on the vertical axis. So basically, on this axis here, you see what happened since March 2020, and then horizontally, so the last 3 months, basically you see what happened from an inflow or outflow perspective. I'm presenting the 20 largest metros. If you want to see more data for top 50 or more than that, just send me a note. Miami stands out strongly, gaining almost 2% in tenants since the start of the pandemic, with small but continued net influx in Q2 of this year. So you see that in the top right, clear COVID winners. Other COVID winners are Raleigh and perhaps somewhat surprisingly, Oklahoma City, big thunder. At the top left are cities that gained multifamily tenants since March 2020, but did not continue the upward trend in Q2 of 2021. That doesn't mean a lot, but we just say, hey, overall, these cities were winners since March 2020, but last quarter, influx actually turned slightly negative. So what do we see here? We see Houston, we see San Antonio in Texas, Tampa, Buffalo still look pretty strong, pulling back only slightly. At the bottom left, that's what we call the COVID losers, at least from a multifamily tenant perspective. As of today, we don't see strong recovery in any of those otherwise strong metropolitan areas. New York, San Francisco, Chicago, DC, their multifamily tenant base just continues to shrink. So when it comes to a tenant rebound in multifamily, we don't see that very strongly back in the numbers. So what may well happen is that folks move into short-term rentals, they move into perhaps even hotels or longer-term rentals that way, Airbnb, or rather in single-family rentals in the burbs. We don't see a strong rebound in apartment tenant demand yet. So last, a quick zoom in on New York and San Francisco, two metropolitan areas that have suffered from significant multifamily tenant outflow, as I just showed you. This data that we present here is at the neighborhood level. So a neighborhood represents a set of census blocks. So those are really very small areas with typically about 5,000 to 10,000 people. Now, admittedly, it's hard to see the exact change in the multifamily tenant base for each of those neighborhoods, but I hope that it's clear that the 4% decrease in New York multifamily tenant population, which again corresponds to minus 157,000 tenants, so quite a few tenants, isn't spread exactly equally. In some neighborhoods, up to 45% of tenants have packed their bags. And while the map mostly colors purple, which is bad, shrinking, there's of course pockets of growth, and even very strong growth, especially on Long Island. That's where I want to be this time of year, but even during the pandemic, New Jersey, Hudson Valley, pockets of strong growth, and of course, Connecticut. We can look at a similar map for San Francisco, and we're out of the Bay Area. The Bay Area is shrinking with about 6% over the last 15 months. And again, that's not really spread equally. One thing that really sets the Bay Area apart from New York, from the larger metro in New York, is that there's very few neighborhoods that picked up tenants over the past 15 months. So whereas in New York, you could say, hey, there's places in New Jersey, Long Island, Connecticut, Hudson Valley, where people moved out to, most tenants that packed their bags in the Bay Area seem to have moved away rather than moving between one of the 11,000 apartment buildings in the area. So they may have moved out really further east. You see Livermore, for example, or they may have moved out to Sacramento or potentially even further south or the mountain states. When we drill down all the way to the asset level, and this is the last thing on tenant migration, of course, highlighted patterns and trends at the state, metro, neighborhood level, but you can also look at individual assets, what's happening there. If you're the owner of an asset, you know all about occupancy rate, but potentially if you're the investor through CMBS or you're looking at a distressed asset, you can use this data to look at occupancy trends. So we create an index for any individual multifamily asset. So here are two examples: the NEMA building in San Francisco and the Geary building in New York. Say both high-profile buildings that were constructed fairly recently, less than 10 years ago. Large, well-amenitized assets, losing both of them more than 20% of their tenant base during the pandemic. But what you can see is that NEMA is already bottomed out in October and recovered almost completely. Geary in New York, on the other hand, has been rebounding only more recently in March. Occupancy is still far below what it was in Q1 2020. Now, of course, rent setting strategies of the respective owners may play a role here, but development and occupancy rates is of course also related to local demand dynamics, as I just showed them to you. So San Francisco losing about 40,000 tenants and New York losing about 150,000 tenants. So quite a dent in demand. So what does that mean for pricing? Changes in tenant demand have implications for the pricing, obviously, of multifamily assets in combination with investor demand for these assets. So to better measure hyperlocal price dynamics, GeoPhy recently launched a multifamily price index that allows for benchmarking of pricing really at that, I call that hyperlocal level, again, at that neighborhood level. So a bit more on these indices. They all use local multifamily sales picked up from a variety of sources, including the county records. The indices are updated monthly, reflecting almost real time what's happening in the market from a pricing perspective. Note that we don't just look at transactions of large institutional assets, so there's no kind of minimum bound here. We also include smaller deals, the occasional distressed sale, and some condo sales if they take place. So that's important to take into account when you consider the numbers that I'll be presenting next, because I think they're going to be pretty dramatic relative to what you may think. So first, let's take a look at the top 10 and the bottom 10 price changes across all metropolitan areas. We measure these price changes since the start of the pandemic, so March 2020. Topping the list here is Phoenix, where the average price level of the 3,500 multifamily assets in the area increased by 19%. So that's only over 15 months. Note there's very few gateway cities in the top 10, but you rather see Denver, price growth of 13%. Nashville, still a small market with about 1,000 multifamily assets at 10%. As Sacramento, like I said, likely the new residence of many ex-San Francisco dwellers, growing at 9%. Even though the multifamily market has generally held pretty steady across the US, supported by historically low interest rates and a barrage of institutional capital, average prices have still come down in some cities. New York is probably not surprising here, with an average decrease in multifamily pricing of 3%. Perhaps more surprising are price decreases in Orlando, Austin, and Houston. Certainly not markets that you would think are declining in price. Part of this may reflect a strong increase in pricing prior to the pandemic and a slow leveling off right now. But another part might be that our index reflects what's happening in the complete multifamily market, not just the institutional part, right? So these are not just the 100+ units, but there's also the smaller assets, and part of that might be distressed. All right, let's look at the price index change just over the last quarter. So on this slide, what you see is again the top 10 and bottom 10. The price changes just over the last 3 months. So Q2. The top 10 includes cities with high tenant influx. Think about West Palm Beach, Phoenix again, Miami, where we've seen pretty strong price increases from 5 to 7% in just a single quarter. New York, if you just look at the last quarter, seems to be staging a comeback, as are some of the cities that were previously seeing price declines, including San Diego and Seattle. So whereas from a tenant perspective, we don't see a strong rebound yet, from a pricing perspective, we see that some of the cities that suffered, I wouldn't say strongly, but that suffered the most, we see some rebound in terms of pricing. So institutional capital, again, flowing into those markets, driving up prices. So then let's look at tenant migration versus multifamily prices. So we know what happened to the tenant base over the last 15 months, and we know what happened to pricing over the last 15 months. So as an economist, I think it's important to understand to what extent, basically tenant migration influences pricing. You would expect there's some relationship there, and there is. I wouldn't say it's super strong, but we can explain some of the price changes that we're seeing. So we got the 15-month change in multifamily pricing on the vertical axis against the change in multifamily tenant population over the same period on the horizontal axis. So we see a relationship between the extent of negative demand change. There's really negative demand change with the exception of 3 Florida cities, and changes in pricing. In quite a few places, prices increased in the face of net tenant outflow. So you can say, oh, that's strange. Why is that? Let me explain why. It's not really surprising. So multifamily pricing represents a combination of future cash flows and then the cost of capital or return expectations. While cash flows in multifamily assets may have suffered slightly during the pandemic, basically with tenant demand going down and rents going down, return expectations have actually come down. So basically prices have been able to rise because investors expect a lower return. The 10-year treasury rate decreased from 3% to a low of 50 bips during the pandemic. And as yield-seeking investors have been allocating capital to real estate, including multifamily, beds and sheds, that combination has led to an increase in prices, even if tenants have moved out of metropolitan area. So that's quite an interesting situation. All right, let's zoom in again on New York and San Francisco. And again, this average price change within a metro masks significant within metro variation. A map that's that's very purple here. At the metro level, we know that the average price change for New York is -3 since March 2020. At the neighborhood level, prices in New York have come down in some places by up to -30%. Note that the neighborhoods with limited liquidity, so few sales, this may reflect the outsized impact of a single or two distressed sales. And of course, there's also quite a few places in New York where pricing actually went up. And interestingly, that's mostly in the outskirts of Brooklyn, Queens, and some places in the Bronx. Places where pricing has been relatively low traditionally or previously to begin with. And you could also call that attractive, obviously. So let's look at San Francisco. Pricing is not dissimilar, at least if you look at the spread in San Francisco. Average pricing only went down by about 1% over the past 15 months. In most of the city of San Francisco, as well as Silicon Valley, you can see that reflected. But Oakland and some neighborhoods like Los Gatos, home of Netflix, in the, I would say now even more desirable Santa Cruz Mountains, saw significant price increases. And the same holds for areas more distant to the city of San Francisco, including Hayward, and more to the east, Pleasanton and Livermore. So quite interesting. You know, traditionally not places that were very expensive, but predominantly workforce housing, where it's now more pleasant to live, given that you don't have to commute all the way into the city. So that wraps up multifamily pricing. Let's talk about tenant health. So the state of multifamily household finances. Some background here. So given that most people use credit, I think you're hard pressed to find people that wouldn't use credit. I think credit cards, bank cards, mortgages, car loans, student loans. Using credit payment data provides an incredibly detailed view on financial situation of individuals. In the waterfall of credit payments, we know that payments on secured credit, think about car, loans, mortgages, come first. Retail cards like American Express, Amazon Visa, etc., and bank cards come next, followed by unsecured personal loans, as well as student debt. Student debt is kind of last in line. Understanding the extent to which tenants are using credit and making payment on each of these credit lines is important. After all, exactly that payment behavior can be a leading indicator for rent payment behavior. And we showed that in our webinar last time, that there's a strong correlation between the credit situation of folks and bad debt in multifamily assets. Well, you as an investor or lender can't really predict the future using tenant credit data. We think you can. Credit data can help investors and lenders prioritize where to play, can help to identify target properties, and of course, it's a useful piece of information for risk management purposes. So let's start with the state of the nation from a tenant financial health perspective. This gives you a nice macro view on tenant credit. And that view, I would say, is overall great. It's just really great. Our data on the US multifamily sector shows that the average credit score of multifamily tenants across the US is higher than ever before at 662. So just to put that into perspective, the US average for all citizens is 711 and an average of 732 for homeowners. So not surprisingly, the average credit scores of tenants slightly lower than homeowners. It's not even that far off. The 662 is a full 6 points higher than it was a year ago, throughout the pandemic, and up 2 points alone in Q2. So to put 6 points again into perspective, a 30-point increase in credit scores lowers the default rate in either one of your credit lines by half. So it's not trivial. The average delinquency rate, kind of in the second column, for all types of credit across multifamily properties now stands at 43%. That may seem high, but the 43% reflects just potentially 130 days past due on either one or more credit lines, including student loans. Even pre-pandemic, about every 1 out of 2 Americans was delinquent on some of their credit. So 43% actually is pretty good. Since the start of the pandemic, the delinquency rate is down by 3%. And over the past quarter, the delinquency rate further decreased by 1.3%. So again, I would say a continuing positive trend in the financial health of tenants. Now, I introduced the payment holiday as a sort of hidden risk for landlords. Deferred payments may pose a financial burden when they finally come due. At some point, you come back from holiday, you got to make payment, right? At this point, 1 out of every 20 tenants is on some form of payment holiday. Now, almost half from 1 out of 10 a year ago. And that number continues to increase, as you can see from the 3-month change. So overall, I would say this is really positive news, but I would say it still remains an important metric for landlords to watch, especially as the eviction moratorium eventually at some point comes to an end. We'll see when that is. What is then the true financial health of the tenant base? So let's look a little deeper. Again, at the micro level. Tenant financial health has really strongly improved against the backdrop of the pandemic, but you really got to understand that there's significant variation underneath the good-looking average. So if we look at all 326,000 multifamily assets in our database, about a quarter of the properties saw no large shift in the average credit scores over the past 12 months, as shown by the teal bars. 53% of properties actually had an increase in credit scores, and on the flip side, 22%, so a quarter of the multifamily assets in the US, saw a decrease in the average credit score of more than 5 points. And it's more than the 16% of properties that saw a deterioration in credit scores in the 12 months ending Q1. So at the level of the individual consumer, a 30-point change in credit score equals a doubling of the likelihood of non-payment. So imagine that a single property sees an average shift in credit scores of more than 30 points. That's quite significant. In this case, about 7% of the stock saw an increase in average credit scores of more than 30%, whereas only 2.4% of properties had an average drop in credit scores of more than 30 points. So the overall picture looks good. But, and that's what I want to highlight here, there's an increasing number of properties where credit scores are going down. And this trend is really worth monitoring. My take on this trend is twofold. First, as payment holidays are wearing off, tenants have to start making payments again, and they have trouble doing so. Second, the tenants that are leaving multifamily assets, and this is important, either to buy a house or to move to the mountains, are actually the high quality credit-worthy tenants, which means that the quality of the multifamily tenant base has been eroding over the last 15 months, even in the assets that are already under management. On the delinquency side, the majority of properties across the US saw no significant change in the average tenant delinquency rate of 43%. Delinquency on credit lines, that's -5 to +5, and again, teals the 12-month period ending Q2. The comparison between the blue bars represented the 12-month period ending Q1, and the teal bars, so that's ending now, highlights a slight increase in delinquency rates of tenants in multifamily properties, but it's only slight. In Q1, about 17% of properties saw an increase in delinquency rates. In Q2, that percentage was up a single percentage point, 18%. So we got to watch this space, but overall, from a delinquency perspective, things look pretty stable. And our last, payment holiday. Here, the distribution is clearly skewed, completely reversing last quarter's direction. We've been talking about payment holiday and the increasing that, but really 22% of multifamily assets saw an increase in payment holiday of more than 5 percentage points over the 12 months ending Q1. We still, this is a thing. In Q2, the percent of properties with increasing payment holidays is down to just 9%. So overall, people are coming back from payment holiday. And the question here is, as people come out of this, will they be able to pick up their monthly payments again? And especially given that the provision of payment holidays might be most concentrated amongst employees in COVID-affected industries and jobs. So overall, credit scores are improving, but about a fifth of the multifamily assets actually sees a decrease in credit scores. We see delinquency rates nudging up a little bit, and a payment holiday strongly coming down. Let's look at the metro level. I think it's informative to look at individual metropolitan areas. So here we zoom in on the at-risk metrics. The percentage of multifamily properties with a 5-point or more decrease in credit scores on the horizontal axis, and the y-axis, that's the percentage of properties with a more than 5-point increase in tenants on payment holiday. I'm showing you those numbers for the 5 metropolitan areas where the number of at-risk assets was highest in Q1. both from the perspective of a decrease in credit scores and an increase in the number of tenants on payment holiday. So if we go from Q1 to Q2 this year, so mostly you go from the upper dot to the lower dot, basically what we see is a very strong decrease in the number of multifamily assets where payment holiday was high. Whether it's Kansas City, Minneapolis, the number of multifamily assets where the number of tenants on payment holiday was increasing is down to almost zero. Really good news. However, at the same time, we see that average credit scores have been decreasing in 3 out of 5 cities, and most strongly so in Minneapolis. So even though the notion of payment holiday is wearing off, we're clearly not out of the woods yet, and there are more and more assets with elevated credit risk. On the next slide, you basically see the higher quality places, at least from a tenant credit perspective. Again, look at what happened over the past quarter. In all metros, the number of at-risk assets decreased substantially when it comes to that increase in payment holiday. For most markets, the number of assets where payment holiday increased with 5 points or more, it's almost zero, 3 to 5%. However, the increase in the number of assets where credit scores were going down with more than 5 points is apparent for every city. In Austin, more than a fifth of the 2,000 multifamily assets there saw a decrease in average credit scores of more than 5 points. And that's at the same level as Phoenix, and there it is again, Oklahoma City. Houston, with about 5,000 multifamily assets, saw a decrease in credit scores of 5 points or more, also in about a fifth of properties. Clearly, as higher quality tenants have moved out, the average quality of the tenant base is suffering. A quick note on small versus large size matters. Here you see a table that looks at changes in payment holiday per metro, with the largest assets on the left and the small assets on the right. And large here is defined as those buildings that have more than 25 units. The top 10 markets are those with the largest increase in payment holiday rates. Top is just considered negative here. There's a stark contrast between multifamily properties based on asset size. In larger properties, the financial health of tenants is somewhat better, as can be seen for pretty much every city, whether it's in the top 10 or the bottom 10. Look at Austin and Phoenix. Look at Boston, San Francisco at the bottom. You really see that once you go from a large asset to a smaller asset, that the at-risk indicators are going up substantially. So even though payment holiday rates are coming down across the board, smaller multifamily assets have a more risky profile from a consumer credit perspective, independent of their location. So as investors move to smaller multifamily assets because there's less competition, there's less capital for those assets, it's really important to start thinking about tenant credit quality, whereas normally that matters much less in larger assets because of diversification. So finally, let's look at the consumer credit situation in San Francisco and New York. On this slide, you see the GeoPhy neighborhoods again. And as a reminder, we've defined 94,000 unique neighborhoods across the US, which about 200 neighborhoods in San Francisco alone. Each neighborhood is a combination of one or more census blocks that look and feel similar. And we scored and ranked those neighborhoods based on characteristics related to demographics, amenities, and housing. So really the things that are important for multifamily. So we highlight the top 5 and bottom 5 neighborhoods by credit score on the left of this side of the slide. The legend provides the average credit score for tenants in multifamily assets within each of those neighborhoods. Now, perhaps with the exception of Palomar Hill, which really isn't a multifamily area, and thus gets a low multifamily neighborhood rating, the ratings correlate nicely with tenant credit quality. High quality neighborhoods and a tenant base with higher credit quality. Now, on the next slide, you can basically see changes in credit quality. And here, a different picture emerges. Red or purple, whatever your preference, indicates a larger fraction of multifamily assets in a neighborhood that has seen a drop in average credit scores among multifamily tenants of 5 points or more. Clearly, high quality neighborhoods are not fully insulated from financial distress. Rincon Hill, top neighborhood in San Francisco, with average credit scores of the multifamily tenant base went down by 4 points. Compare that to B-rated Hillside, San Rafael Creek, where average credit scores actually increased. Again, even within the metro, there's a lot of variation in the financial health of tenants. You could use this kind of data to determine where to invest or lend, or to identify target properties from a distress perspective. And then last, New York. New York typically comes first, but now comes last. 871 unique neighborhoods. And not surprisingly, credit scores are highest for multifamily assets in places like Park Slope and the Upper East and West Side, all A+ neighborhoods. Average tenant credit scores are much lower in the Bronx and East Brooklyn. But now let's look at changes again. Comparable to San Francisco, we're seeing a much more positive trend in credit score increases in lower credit neighborhoods. Whereas most neighborhoods in Manhattan are seeing more than half of assets having a more than 5-point decrease in average credit scores of tenants. That's a lot of halves there, but basically things are going down in Manhattan. The Bronx, Queens, and the not Park Slope part of Brooklyn have just a handful of assets where credit scores actually went down. So this is likely, again, the result of tenant flight out of high quality assets in New York, and then tenants remaining put in workforce housing with general improvements in their credit situation, probably due to the stimulus money. So wrapping up, there was a lot of data here. A couple of key takeaways. I would say that our continued insights into tenant migration in and out of multifamily assets show some clear COVID winners, and most of all, clear COVID losers. The predicted rebound of tenants moving back into multifamily assets is slow to materialize. Second, multifamily pricing overall looks strong, but there's quite a few markets where prices have come down, although they're not large changes, but I would say it's important nonetheless. Third, along with the rollout of vaccinations and the improving public health situation, financial health of multifamily tenants is on the rise. Credit scores are up, delinquency rates are down, at least on average. And the devil is in the detail here. The number of tenants on payment holiday is still elevated, but has come down rapidly. The question is whether that unwinding will be unwieldy or orderly, given the extraordinary amount of stimulus. At least if those checks reach the folks that need them, I'm quite positive that most tenants will be able to start payment under debt and credit again. Although everything looks pretty good on average, we should be mindful of the significant variation in tenant credit conditions across geographies, as well as across different multifamily assets. Now, the brunt of risk here is borne by lenders and investors in smaller properties. I would say that the combination of these insights with other indicators of demand provide useful information for lenders and investors in order to prioritize where to play, to evaluate and prioritize opportunities according to market, submarket, neighborhood size, attractiveness, and risk profile. In addition, the information can be used to identify target properties, as I showed you with the migration indices for individual assets, both for investing and lending, as well as for risk management purposes. And with that, Chris, back to you.
Thank you very much, Nils. We've got a few minutes to answer your questions, which have been coming in through the Q&A feature on your screens, and please keep sending them and we'll respond by email if we don't have time to answer them all. So Nils, the first question to you, can you pull back and show neighborhoods across Northern California, say to see neighborhoods around Sacramento gained multifamily tenants while the Bay Area saw its multifamily population shrink?
Sure. Yeah, basically, I showed you both the neighborhoods and individual assets. So we can do custom reports basically for every region across the US within a metro area. You can go down as granular as into the individual assets. So you can access that data through Evra or our online data tool, or basically we can provide that in batch form. But any place across the US, you can zoom in either at the metro, the neighborhood, or the individual asset level.
We also have another question, Nils, about the multifamily price index, price indices, and how they are created. So that's the question. How are your multifamily price indices created?
Yeah, sure. So basically, we collect sales transactions on a monthly basis. One of the sources is the county records across the U.S. Data history goes back to 2005, so about 16 years of data. We aggregate sales at different geographic levels, but the finest level of granularity here is the neighborhood level. So that's quite unique. So you get basically price indices for these very small areas, much smaller than submarkets across the US. So we cover about 10,000 neighborhoods across the US. And what we can do is either give you a full index, 1, 3, 5 year compound annual growth on the capital side. Yeah, so that's what the price indices do.
All right. Well, that's the questions that have come in. And thanks again, Nils. And thanks everyone for attending. A quick reminder that we will be sending along a recording of the event tomorrow, along with the slides. And if you would have any remaining questions or comments, please reach out to us at events@geophy.com. And we'll be sure to answer them as soon as possible. See you all again soon in October for the Q3 update.
Thank you.